want to talk about the differences between traditional IRAs and Roth IRAs. Uh, First of all, IRAs are a great way to supplement retirement savings. So if you're not taking advantage of them, I'd really encourage you to do so. And which plan makes the most sense for you will really depend on your own personal circumstances. So one of the main similarities between the two plans, a traditional and a Roth, is the fact that you can make up to a $6,000 contribution on an annual basis. If you're over the age of 50, you can add another $1,000 to that. So you can make a contribution of up to $7,000 in either a traditional IRA or a Roth IRA. One of the main differences between the two is how they're taxed and when you get the tax benefit. A traditional IRA, basically you get the tax benefit when you make the contribution. You're able to write that off on your taxes and get that tax benefit today, allow that money to grow tax deferred, and when you start taking distributions at a later date is when you start paying taxes on those distributions. A Roth IRA, you get no tax benefit today by making those contributions, but then that money grows tax-free. So when you start taking distributions at a later date, you pay no income taxes on those distributions. So again, traditional IRAs, you benefit more today for your taxes, and in a Roth IRA, you benefit more at a later date. So if you think you're going to be in a higher tax bracket in retirement, a Roth IRA probably makes more sense. If you think you're going to be in a low tax bracket in retirement, maybe a traditional IRA makes the most sense. And also on traditional IRAs, the contributions that you make may not be tax deductible if you have a retirement plan at work and hit some income level restrictions. And if that's the case, you probably want to make a Roth IRA contribution. But Roth IRAs also have some restrictions as far as income limitations. If you're single and you earn over $129,000, you're ineligible to make a Roth IRA contribution. If you're married, filing jointly, and you earn over $204,000, you are ineligible to make a Roth IRA contribution. Now, there are some ways to get money into a Roth IRA if you're over those income limits by way of what they call the backdoor Roth contribution. And there will be a video that covers that topic at a later date as well. So the magic age with a traditional IRA is 59 and a half as far as distributions go. Once you hit the age of 59 and a half, you can take as much out of that account as you want, as little as you want, and whatever you take out, you pay income tax on. You don't have to take any distributions until you hit the age of 72. At age 72 in traditional IRAs, there's what they call a required minimum distribution. And that's a minimum amount that you have to take out of the account on an annual basis. It's based on your life expectancy. So there's a calculation that you run through that'll say, here's how much you have to take out. And if you don't, IRS is going to penalize you 50%. So important to take those distributions out when you hit the required minimum distributions. Now, Roth IRAs, on the other hand, don't have a required minimum distribution. 59 and a half is also, though, that magic age where you can start taking distributions without taxes and penalties, as long as the account had been open for 5 years. And then, like I said, at age 72, there are no required minimums. So essentially, you wouldn't have to take any distributions out of that account if you didn't want to. But any distributions that you do take are tax-free. So Roth IRAs can be a good estate planning tool to allow you to pass assets to your beneficiaries tax-free. So speaking of beneficiaries, spousal beneficiaries on both a traditional IRA and a Roth IRA, they can, there's different ways you can approach it, but both can basically take that account over as their own. Distributions will be based on their age. A non-spouse beneficiary in both the traditional IRA and a Roth IRA, those accounts need to be liquidated within 10 years of death. So traditional IRAs, whatever you take out will be taxed. You don't have to take a 10th out every year. You can take it all out year one and pay taxes on it. You can leave it alone and take it all out year 10 and get taxed on the full amount. Or typically we work with our clients to figure out if they have a low income year, maybe that's when you want to take out more from that beneficiary IRA, and vice versa. If you have a high income year, you want to take out a little bit less. So you want to optimize your tax situation. Roth IRAs, again, the account needs to be liquidated within 10 years, but there's no income tax that you have to pay on those distributions. So you could leave it for those 10 years and take it all out at the end and pay no income tax. So with that, those are the main differences and similarities between the accounts. What's going to be right for you may not be right for somebody else. If you have questions, please don't hesitate to reach out. We'd be happy to kind of walk you through what may be most beneficial to you. If there's any topics of videos that you'd like to see on this page, please in the comment section let us know. And also, please don't forget to subscribe. Thank you.